Hello again, and thank you for joining us for today's webinar. For those of you who may be new to Source Advisors, we've been helping CPA firms and their clients maximize federal and state tax incentives for over 40 years. We're headquartered in Fort Worth, Texas, where we work with accounting firms across the country to deliver expert guidance in areas such as the R&D tax credit, cost segregation, LIFO, energy efficiency incentives, sales and use tax, and property tax consulting. Before we get started, just a few housekeeping items. There will be 4 polling questions today. To qualify for CPE, you must answer at least 3 of them and attend a minimum of 50 minutes as tracked by the presentation software. CPE certificates will be sent via email within 3 business days. Additionally, please use both the chat and Q&A features located in the upper right corner of your screen. If you have a question specifically for our presenters, be sure to use the Q&A panel, as we'll reserve time at the end of the session to address as many as possible. Lastly, a PDF of today's presentation is available for download now, should you wish to follow along or reference it afterward. With that, let's get started, and I'm pleased to announce our speakers. First is Jordan Fazio, who's a senior director from Detroit. Jordan became a part of Source Advisors in 2015 and is now a senior director for R&D tax credit consulting. His main duties involve guiding CPAs and taxpayers with R&D tax credits and overseeing R&D tax credit projects. Prior to joining Source Advisors, he accumulated 8 years of experience in market risk management, software development, and operations within OTC markets. Also joining us today is Imran Syed. Imran joined Source Advisors in 2010 and is currently the managing director of energy services. Imran is a mechanical engineer by trade and has more than 15 years of experience in sustainability and energy efficient buildings. He is a registered professional engineer, a certified energy member, a lead AP, a HERS rater, an NGBS verifier, and an Energy Star partner. And with that, I will hand it over to Jordan.
Thank you, Ann. Certainly sounds like I need some more certifications to keep up with Imran. Thanks for joining, everyone. Just to get started, I know the main topic at hand is Section 174 amortization, One Big Beautiful Bill Act, and kind of how we're going to unwind things or where the world sits today. But I think it's important just to take a step back and talk for a moment about the R&D credit and some of the qualification. Oftentimes they're very closely coupled, so understanding one is kind of key to understanding the other in my mind. In front of you, you'll see the 4-part test, which I'm sure many are familiar with. This is pulled directly from Code Section 41 that dictates our increase for research activities credit. This is an all or nothing type test. We have to be able to answer affirmative to all the boxes on the screen or have a justifiable answer in order to grab the expenses touching these activities and generate a tax credit from it. It goes as follows. First part, new or improved business component. What this means is we're intending to create something new or improve upon something existing for a permitted purpose. What that something is can vary, right? We can have a product, it can be a manufacturing process, a formula, a technique, a piece of software. If it's new, pretty simple. If we're improving upon something existing, it really has to be by a metric listed on the screen: functionality, increased performance, reliability, or quality, any of those items. What you won't see here is things for aesthetic purposes, right? That doesn't really hit home with the credit, so it has to be weeded out. The second part of the 4-part test is that fundamentally our activities have to rely on a hard science. I'm actually on the 3rd part already. We changed the order of these. My apologies. Technologically, we have to be relying on some type of hard science. Again, we need to weed out the soft sciences, social sciences, things like market research in this exploration. The 3rd and 4th part really play together. It's where the rubber meets the road for the R&D tax credit, I like to say. The elimination of uncertainty test states that we cannot know exactly what we're doing or how we're going to do it at the onset of these projects. There have to be technical questions about whether or not we can be successful. A few items are listed on the screen in front of you here. Capability is often a big uncertainty. Is it even possible for us to do this? Are we looking at this from the right angle in terms of the methodology in developing our product or manufacturing process? And then finally, the appropriateness of the design. Is our product design even proper? Is it going to do what we need to do? These questions, one or multiple, may be sitting there at the onset of these projects. How do we unravel it? It's the fourth part of the four-part test, our process of experimentation. I really like to think of this as the scientific method from grade school in the process of experimentation. We're going to establish some hypotheses based off best known information, understanding that we have uncertainty unravel, and we're going to design some type of experiment around it to see if we're successful or not. What your process of experimentation is depends a little bit on the domain of the R&D itself, right? If we're developing software, that's probably going to be writing some code, doing some testing at various intervals. If we're actually a manufacturer creating a physical prototype, it is the prototyping process. We're going to have designs. We're going to actually create something physical. We're going to test it for fit, form, and function. There may be subsequent iterations from there. So that is our four-part test that kind of dictates what types of activities can we include in the credit. On the expense side, on the left hand of the screen here, we see the Code Section 41 qualified research expenses. These are the items that if we have that four-part test occurring, we can grab those 4 buckets of cost to help generate credit to the proportion they're actually used in R&D. The largest driver of these credits is typically salaries and wages. It starts with box 1 W-2 wage. And we can have 3 levels of research occurring with our salaries and wages. There's the direct research. Think of this as our scientist, our engineer, our technical discipline. There's direct supervision of the research, our engineering manager or director, our head of development that all these folks are reporting to. The direct supervision of the direct research is a qualified activity on its own. And then finally, direct support of research. This can be a lot of different things, and it's typically where we see folks outside of the lab environment getting involved. But think about testing. Think about if we're making a physical prototype, who are we grabbing from the manufacturing facility to actually build that prototype? Great examples of support on the wage front for the research credit. Computer rental or lease, this is really cloud computing environments, and it's relegated for our clients that are developing proprietary software. So back in the early 80s, when the credit came about, this was really a provision in the code for leasing of mainframe computers. And the textbook definition of a mainframe computer versus what we now know as these cloud servers, very, very close. You were paying to lease compute power and RAM just as you are now in the cloud. So to the extent that we are developing, not on local machines, but on an AWS partition server somewhere, we can include that cost in the accumulation of the credit as well. Contractors, third parties that are hired to do work on our behalf, to the extent they're meeting the 4-part test, doing their work in the United States, keynote there, United States versus abroad, that'll come up in our 174 discussion here. You can use those costs as well. There's a 35% haircut applied to those contractor costs, just trying to make it apples to apples in terms of benefit of an employee versus a third-party contractor being brought in. And we do need to do an analysis on funded research to see if they hold the rights and the risk behind what's ultimately being developed. And then the fourth and final costing bucket is supplies and materials, items that are used up, consumed, or destroyed in our R&D. Now, if we contrast that with Section 174 expenses on the right hand of the slide, it's everything on the left hand of the screen, right? Plus everything kind of incident to development. So all of our labor costs, all of our material costs, our contractor costs. In addition, depreciation expense, patent costs, allocation for certain portions of the building. Oh, which brings us to our first polling question.
All right, this is kind of a fun one. Who will win the Super Bowl? The first is the Los Angeles Rams, B is the Seattle Seahawks, C, Denver Broncos, or D, the New England Patriots. Somebody got right off the bat with the Pats. Again, you do need to respond to 3 of 4 polling questions and attend for 50 minutes in order to be eligible for CPE. And it looks like it's equally matched between Seattle and New England. We will keep that open for just a few minutes. And Jordan, I think you can move forward.
Okay, perfect. Okay, so taking a step back, pre-OBBBA, what was 174 amortization? Where did it come from? Well, in 2017, we had the Tax Cuts and Jobs Act. And that was when the actual change occurred to switch from our historic, you're able to either capitalize and amortize or expense your 174 items, to this motion towards requiring the capitalization and amortization. That change, while it was passed in 2017, it had a fuse on it. There was a delay. It did not go into effect until tax year 2022. Once that came to pass for tax year 2022, through 2024, as today stands, domestic and foreign Section 174 expenditures must be capitalized and amortized for 5 years, anything domestic, 15 years for the foreign items. Keynote: the amortization of these expenditures was required regardless of whether or not a taxpayer claimed a credit, which we have covered in some of the examples here to talk through. Okay, what exactly changed in the OBBBA before we start getting through some of the real life examples and what do we do next? Well, for tax year 2025 and forward, all taxpayers, the domestic Section 174 expensing regime is gone. They can be immediately expensed anymore. No more requirements to capitalize and amortize these items. We're not pushing taxable income up in current year anymore. Should be noted that foreign amortization requirement for any research and development done abroad is still intact. Still have to capitalize and amortize those items over a 15-year period. All taxpayers have the option to accelerate any remaining unamortized amounts over 1 or 2 years. And as we get into the detailed examples, we'll clarify that clearly. But everyone can unwind what has been done at this point on 25 and or 25 and 26 tax returns. Eligible small businesses per OBBBA. I know there's a lot of different eligible small businesses in the code, but this one specifically created an eligible small businesses for the purposes of Section 174 Cap A. To be considered an eligible small business, you have to have average annual gross receipts for the tax years 22, 23, and 24, sub 31 million. Control group rules do apply to that test. Very important to look at the entire group when we're evaluating those gross receipts versus just one entity in the mix. These rules are, again, applied at that control group level. So a few examples. The first one, if we have an eligible small business, so a taxpayer whose gross receipts were underneath that $31 million on aggregate from 22 to 24, they are able to make a retroactive election for tax years 22 through 24. If they do want to make that election, go back, amend their returns, get the expenses back on the books, the following must happen. The election, underneath One Big Beautiful Bill Act, there was 1 year period to elect as an eligible small business for purposes of 174 Cap A. I think July 4th is a Saturday this coming year, so we have until the 6th. July 6th, 2026 is a very important election date. If a taxpayer does want to unwind their prior amortization, they must amend the return and make that election by that 7/6/26 date in order for it to be eligible. If they make that election, again, and they had taken a R&D tax credit in that time, one of the things that we saw, it was very common because of the loss of deductibility of these expenses, the gross credit and the net credit were effectively equal, or excuse me, you were allowed to take that gross credit without any add back implications for the majority of taxpayers. So a lot of taxpayers claim the gross credit in tax years 22 through 24. Along with making that retroactive election to reinstate the expenses, they can also, for the first time ever on an amended return, elect 280C. So they can make that 280C election in order to reduce that credit and not have to add back to net income. If they're not making the retroactive election, if we have a taxpayer who just doesn't want to amend any returns, they're not interested in doing any of that, they can accelerate those unamortized amounts in 25, split 50-50 between 25 and 26 to carry out. Or finally, they can carry out that amortization schedule. So can take all those remaining unamortized amounts in 25, or they can split them between 25 and 26, or they can just continue to take those tranches that they've already capitalized in the previous into perpetuity, or into probably about 28, 29 would be the last year that they have those expenses sitting there. This is an important tax planning note here, right? it's going to be important to understand what the tax liability is going to be in 2025 before making these decisions. We're anticipating that a lot of taxpayers are going to be letting these hit in 25 and or 26, and there may be an NOL situation that comes about at the end of the day. Eligible small business that have not been amortizing under Section 174. Well, very similar to our last group, they're also able to make the election as an eligible small business. If making that election, same rules apply. 7/6/26. I'll probably say it 10 or 15 more times because this is an important deadline. 7/6/26 is the key date that it must be in by. Now, certainly, if we had a 2022 tax return that was filed timely, much more important date is going to be our statute date that would fall off in advance of 7/6/26. But keep in mind, even our extenders for 2022, 7/6/26, is going to be the important new deadline to pay attention to. So if our taxpayer, again, had not been amortizing under Section 174, they could also make this election. And what it does is it changes the effective date of One Big Beautiful Bill for that taxpayer. It changes the effective date from 12/31/24, tax years 25 and forward, to 12/31/21. Effectively making it so that amortization never should have been an issue, right? If they make that election at the same time, they can claim the R&D tax credit. They're already amending their return, and it's a nice opportunity to capitalize on some benefits that maybe had been left to the side because of unadvantageous tax impacts at the end of the day. The election only relates to the expensing of domestic R&D expenses. Again, those foreign impacts are still in place. And if we are not making the retroactive election, the election statement is also required to elect 174 Cap A for 25 and forward. So if we're not amending any prior returns, not making those elections, it will still be key to make sure the election is on the 25 return, acknowledging that we want to move under that method of 174 Cap A. Large businesses that have been amortizing under 174. So they're over 31 million. They've been following all the compliance rules and reading the tea leaves. They're up to date. They've got options, right? They can, again, like all other taxpayers, they can accelerate any unamortized amounts from 22 to 24 on the 25 tax return via an election statement. They can also choose to split it between 25 and 26 via an election statement. Or, much like our last group, they can also continue with the normal amortization schedule for those years that were capitalized 22 through 24. Tax year 2025 will revert to full domestic expensing under 174 Cap A if so elected via statement, and R&D credits will be computed on either their gross or the 280C election. If we have a large taxpayer who is going to be bringing all of those prior year expenses into 2025, again, they may be forced into a loss position, and it may make more sense to claim the gross credit to chew down some of that loss versus the net credit. Nice note on tax planning, right? Look at those NOLs. Try and understand what is the impact going to be of unraveling this 174 conundrum, so to speak, to make sure that our taxpayers are taking advantage of the rules in the most advantageous way. So probably the most interesting bucket would be the large businesses that have not been amortizing under Section 174. Get asked this question often right now. And the real answer is there's no pathway to cure for the lack of prior amortization, right? There was a gap in compliance effectively. There aren't any cures to go get compliant at this point now that 25 is in the rears and we're dealing with 25 taxes. It should be noted, though, those R&D tax credits are still permanent benefits, while the amortization, it's a timing difference, right? While it had a real impact on cash flow, it is very much a timing difference that plays out over time. That R&D benefit carries forward up to 20 years, carries back 1 year, and it is a permanent part of the tax code. So for these large businesses that have not been amortizing under Section 174, they're already out of compliance. Does it make them less compliant to claim an R&D tax credit? I would make the argument that the compliance issue is the compliance issue, and claiming the R&D credit doesn't necessarily impact the lack of compliance on one side or the other. But take advantage of the R&D credit, limit your exposure on that 174 timing by making those elections to accelerate the unamortized amounts fully on the 2025 return. Every client has specific circumstances here, right? Every client has different businesses, different levers being pulled. And really, in the R&D world, everything is kind of use case dependent. So I highly recommend, if you have one of these challenging situations with a large taxpayer that hasn't been compliant and trying to figure out what to do next, let's talk about the details, right? Instead of just kind of blanket prescribing for all taxpayers, these are the exact steps to take. I think for these larger ones with the potential compliance hole, it does make sense to have a more of a detailed deep dive conversation about their scenario and how the rules can be applied to them in the best way possible. Which brings us to another polling question.
Okay, this seems to be a theme. Who do you want to win the Super Bowl? A little bit different question. Rams, Seahawks, Broncos, or Patriots? And Jordan, there is a question or a comment for you. Let me know if you'd like me to read it.
I see Delaware and some other deep blue states decoupled from the federal and still require 174 capitalization and amortization commencing 2026. Yes, it is not uniform. Different states are not following one big beautiful bill. Some are. Michigan, for example, is not. It's really a case by case basis. Now, again, that's not the best answer at the end of the day, but there will be states that do not conform to this, and there is still going to be a 174 amortization requirement. Again, use case specific. And do we have example elections? Yes, we do have election statements available. But yeah, sorry, back to the state issue. It is very much a case-by-case basis, and I think there are many states trying to get something done right now. But the timing difference for the state level benefit versus the federal level benefit, it really, the federal impact is so much greater. What we saw when this amortization requirement came about in 2022 tax filings is that just the sheer amount, the tax rate, coupled with those amounts needing to be amortized, was creating the largest hit to cash flow. Certainly the states are going to continue to have a negative impact if they don't conform to OBBBA. And that probably should have been a polling question. What should we call One Big Beautiful Bill Act? But yes, great comment on the states. It is not uniform, and it varies greatly depending on what part of the country we're in, who the governor is, et cetera, et cetera.
Great. I think we are all set. Any other questions for Jordan? Okay, then I will turn it over to Imran.
All right. Thank you, Anne, and thank you, Jordan, for the presentation. So the second part of the CPE presentation mainly focuses on the Big Beautiful Bill and its impact on various energy incentives. And as I go through the slides, I will highlight some of the varying sunset dates for energy incentives. And these could be critical for clients who may be thinking about starting a project or beginning construction at some point in the near future. And hopefully, in order to capitalize and maximize the tax incentives, some of these milestones or deadlines may be useful to help make those decisions. There will be a few legacy energy incentives we'll go through. And the goal is not so much to go through a 179D or a 45L101, but it's mostly about what these OBBBA impacts is going to be with regards to when these incentives will be expiring. And then we'll cap it off with some of the investment and production tax credits. A quick background on Section 17090. It's a tax deduction for commercial and high-rise residential properties. And when I say high-rise residential, that's 4 stories or higher. It's been part of the tax code since the EPACT of 2005. So again, it's a legacy tax deduction. It's been there for a while. There are 2 verticals for 17090. If a building owner owns or leases a commercial building or a high-rise residential property and has spent on the energy efficiency components of the building, the property is eligible for a 17090 tax deduction. On the flip side, if it's a government or a non-for-profit building, and since those buildings are tax exempt, the deduction can be allocated to design firms. And this is where, if you have clients who are architectural engineering firms who work in the public space or the non-for-profit space, those clients can surely go after the 17090 tax deduction. Now, since 17090 has been part of the tax code for a while, the deduction ranges depends on the placed in service year. So pre-Inflation Reduction Act, and as we go through these slides, you're going to see some slides that are going to be pre-IRA, and then a couple of years of the Inflation Reduction Act, and then obviously with the new big beautiful bill, those rules and criteria might be slightly different. But let's quickly go over the pre-IRA requirements. And the reason for going through this is for commercial building owners or high-rise residential building owners, they still have the chance to go back and take a deduction on a prior year project without having to amend their returns. Filing a 3115 will be sufficient. And therefore, we still run into projects which are pre-2023. But the deduction for the longest time remained the same, and that was a maximum of $1.80 per square foot. So that was the maximum deduction that a project could qualify for. And then if a project didn't get the full 50% savings criteria, you did have the ability to qualify each of these systems, the lighting or the mechanical HVAC or the building envelope, for 60 cents per square foot each. So you had various ways to qualify for a 17090 tax deduction. Just one thing to note here, with the pre-IRA projects, design firms do have the 3-year statute of limitation. And therefore, for design firms, projects that were placed in service in 2022 may still be viable for the 17090 tax deduction, although they do have to amend their tax returns. So that was pre-IRA. With the Inflation Reduction Act effective 2023, the $1.80 per square foot deduction went up to $5 per square foot. So again, there's a few rules behind it, but in general, the deduction could be up to $5 per square foot. Now, the requirements, which was very typical for the IRA tax regulations, where there was a base incentive and then there was a bonus incentive if the prevailing wage and the apprenticeship requirements were met. And that's the case with 17090 as well. So a base building that does not meet the prevailing wage and the apprenticeship requirements, that deduction range was 50 cents to $1 per square foot. And if a project met the prevailing wage and the apprenticeship requirements, or if the project started construction prior to 1/29/2023, in which case you were exempt from PWA, that deduction range was $2.50 to $5 per square foot. And as you can see on the slide, each tax year had an inflation adjustment, the most recent being 2026, where project that meets the PWA requirements could be anywhere from $2.97 to $5.94 per square foot. Again, significant tax deductions for projects that meet PWA. And even for projects that do not meet PWA, that's up to $1.19 per square foot. So any project that gets placed in service in 26, you are looking at the higher tax deduction ranges, depending on PWA or non-PWA. Now, the big beautiful bill sunsets Section 17090 for projects that begin construction after June 30th of this year. So if projects start prior to that date, 179D still applies. Any project that starts on or after the 1st of July, that wouldn't be eligible for Section 179D tax deduction. Now, our opinion is that at some point, 179D will retroactively be extended, but for now, these are the rules. Now, as we go through the next slides, we'll talk about what exactly beginning of construction means. Is this truly work of physical nature, or are there other safe harbor rules as well? A quick case study for the 179D tax deduction. Here's a project, not too large, about 19,000 square feet in total, designed for a government entity, and therefore the architectural firm was able to get the tax deduction. As you can see, a 19,000 square feet building received about $100,000 in tax deduction. Now, 45L is a counterpart to Section 179D. It applies for residential properties. Now, prior to IRA, which is pre-2023, this was limited to 3 stories or lower. Starting from 2023, that limitation was removed, and therefore it can apply for mid to high-rise residential properties as well. The Inflation Reduction Act did make the qualification criteria a little more stringent. Energy Star certification was a requirement in order for the project to qualify for 45L. And then the zero energy certification would get you a higher tax credit. And the tax credit was $2,500 for Energy Star, $5,000 for the zero energy ready home certification. Now that's generally what the rules are when it comes to single family, townhomes, and duplexes. When it comes to multifamily projects, in order to get the higher tax credit, prevailing wages must be met. If not, the credit comes down to $500 for Energy Star, $1,000 for the zero energy certification. Now, this credit has the most impact because of the Big Beautiful Bill, and that's because the units must be leased or sold before June 30th, 2026 in order to be eligible for the tax credit. If you notice, this is slightly different than 179D. 179D had the beginning of construction start date as June 30th. For 45L, it is truly units leased or sold, which basically what it boils down to is most multifamily projects that are under construction or about to start construction, and if they don't expect those units to be leased by middle of this year, those projects probably won't qualify for 45L. Single family projects generally take about 3 to 5 months to get completed. And we are still seeing a lot of single family builders come and qualify these projects for 45L. And so look out for single family, duplex, or townhome clients. Multifamily projects might be a little bit late unless 45L does get extended retroactively at a later stage. A quick case study on the 45L tax credit. Again, self-explanatory. This is a multifamily builder, 144 units, did require prevailing wages, and thankfully they were paying Davis-Bacon wages because of the low-income housing tax credit. And so that resulted in $5,000 per unit credit, $720,000 in overall tax credit. So again, when 45L was still active under the IRA with the Energy Star rules, we've seen a lot of multifamily builders qualify and get substantial tax credits. Another case study, this is for a home builder, single family, 20 homes, went after both the Energy Star and the zero energy certification. And similar to the previous case study, $5,000 per unit, $100,000 in tax credit. One of the things to remember with either certifications, whether it's Energy Star or the zero energy certification, these are not certifications that you can complete once the project has been finished or placed into service. This is truly engineering-based studies, which means we as a firm, as a department, must be involved early on in the design phase to make sure we guide the design team towards these certifications. And then there's inspections that also must be completed during the construction in order to qualify these projects. A quick summary, again, I've probably repeated myself a couple of times here. 179D, the 30th of June date pertains to the beginning of construction date. 45L is for units leased or sold prior to 1st of July. As I mentioned earlier, there are two tests that you can use to either grandfather or qualify these 179D projects. One is a physical work test, which basically means work of significant nature has already started, foundation work or framing or preliminary site work. All of that would be eligible under the physical work test. And the easiest way to prove that is photographs, and you probably have a pay application that proves that construction actually began by a certain date. The other is the 5% safe harbor rule, wherein if 5% of the cost of the project was incurred by the taxpayer by June 30th, 2026, even if work of physical nature might not have started, that project can still be eligible for 179D. And for me, again, this is the takeaway from this slide. Clients thinking about projects or starting projects, that tax or that sunset date might really help them make those decisions to start those projects as soon as possible. All right. It's the third polling question.
All right. Just a moment. Okay, which building does not qualify for 179D, the commercial building tax deduction? A is auto dealership, B is public school, C is single family home, or D, none of the above?
I don't have the fun polling questions. So.
This is fun. Also, there is a question. I don't know if you would like to address it now or wait till the end.
No, I can take care of this. So the question is, if project is not completed by June 30th, 2026, can you still receive the 179D deduction? And the answer is yes. That cutoff date is just for start of construction date. Project can be completed after June 30th, and it would still be eligible for the 179D deduction. The deduction range obviously depends on whether the project meets the PWA requirements or not. All right, moving on. So I went through a few of the requirements for certifications for Energy Star and for the Zero Energy certification. I do want to add this for CPAs who deal with affordable housing developers and low-income housing tax credits. There were quite a few positives that came out of the Big Beautiful Bill. The 4% tax credit still remains in place. The 9% credit allocations have been increased to 12% through 2029. So there's significant tax credits, especially for builders who were planning for the 9% tax credit. They can possibly go after the 12% tax credit now. One of the requirements with most low-income housing tax credit projects, and again, this is dictated by the state housing agencies, but majority of them require some form of a third-party certification in order to be eligible for low-income housing tax credits. National Green Building Standards, Energy Star, Enterprise Green Communities, these are some of the certifications that are acceptable by the housing authorities. So if clients ever need it, there's always a requirement for these certifications to be taken. So more than happy to help out with those. All right. Now moving into the investment and the production tax credits, and I carved out a separate slide for solar and wind projects. And the reason being, this has been negatively impacted by the Big Beautiful Bill. And there are some critical milestones that must be met in order to be eligible. So I'll go through this. With solar and wind, again, this only applies to these eligible properties. Since we are already in 2026, let me start with the 2026 construction start deadline. Projects that start construction between the 1st of January and the 4th of July 2026, you do have a 4-year period to get the project placed in service. However, every project that starts this year must meet the foreign entities of concern restrictions, which we will go through in a little bit. For projects that start after the 4th of July, you don't have the 4-year limitation. You do have to get the project completed by the end of 2027 in order to get the tax credit. The tax credit is about 30% of the cost of the project under Section 48E. And then there's some additional bonus credits. There's a 10% bonus for domestic content. There's an additional 10% if it's an energy community. And so you're looking at anywhere between 30 to 50% of the cost of the project coming back as a tax credit. So 2026, you do have that 4th of July deadline to meet in order to have that 4-year continuity safe harbor. But irrespective of when you start construction in 2026 or 2027, the FEOC restrictions must be met, which means there's a little more documentation that needs to be done. Now, I'll take a minute to go over to the 2025 projects, because for the 2025 tax year, we'll be looking at quite a few of the Section 48 or the 45 tax credits. There are no requirements to be met with regards to the foreign entities of concern. So Section 48 and 45 would still use the legacy rules with regards to solar and wind, and should be a fairly straightforward process. Now, there was some guidance that was provided with regards to the maker's property, and our understanding is anything that is considered an energy property would still be getting a 5 years maker's classification, along with the bonus depreciation that applies for projects after 19th of January 2025. One more piece of critical advice here with regards to the beginning of construction tests. After 9/2/2025, all the way through 26 and 27, if a project is more than 1.5 megawatt, the only way you can prove your construction start date is going to be the physical work test. Projects that are smaller in scale, less than 1.5 megawatt, you have both the physical work test or the 5% safe harbor rules that you could use. Yeah. So that's the solar and the wind portion. Now, for most other investment and production tax credits, whether it's fuel cells, battery energy storage, geothermal heat pumps, each one has a sunset period, but it's no earlier than 2030. So there's, again, most of the other ITCs and PTCs do still exist, and in some cases have actually been expanded. So nothing really changes for most of them. 45X is one tax credit that's been gaining traction quite a lot in the last few years. This relates to eligible properties and components that are manufactured and produced in the United States. And so this includes wind, solar, batteries, and critical minerals. Wind energy components, that's the only thing that does have an early sunset date, and that happens to be end of 2027. Anything after that would not be eligible for the 45X tax credit. Solar components, batteries, and critical minerals, all of these at least start phasing out at 2030. So you do have a little bit of a runway to utilize the 45X tax credit. Now, the reason I don't mention the tax credit amounts on this slide is it varies depending on the eligible component. So it's a little different for wind energy components. At the same time, battery components may get a different tax credit amount. As I mentioned in the last couple of slides, the 5 years makers classification still exists and still applies, along with the bonus depreciation rules, which again is similar to cost segregation studies. As of 2026 or end of 2025, most of the residential improvement credits, whether it was 25C, 25D, which had to do with solar installations or heat pump or residential improvements made inside a building. All of those have expired by or at the end of 2025. So you don't have any of that tax credits existing. One of the positives that came from the Inflation Reduction Act was the ability for non-for-profits and government entities to use the elective pay option, and that still exists as long as it's an eligible property. So I mentioned about the FEOC restrictions, and this is a term that you all will probably be hearing a lot more starting from 2026. And that basically, in a nutshell, means if you are taking an investment or a production tax credit, whether against your own taxable income or planning on selling these tax credits, the FEOC restrictions will apply. And in a nutshell, all that it means is you cannot have ownership with an SFE or a specified foreign entity. A terrorist group or a Chinese military company would not be eligible to take the credit. Same thing applies, and same thing applies with the FIEs as well, where the ownership percentage will be looked at. So if you are able to comply with the SFE and the FIE, again, should be straightforward, and it's an easy compliance to make. But then you do have to meet another restriction, which is the material assistance cost ratio. And the rules behind this is no more than 40% of the cost of the eligible system can be manufactured or produced from any of the specified foreign entities or foreign influence entities. And generally, 4 countries are named under the regulations. It's China, North Korea, Russia, and Iran. So as long as it's not from any of these entities, or even if they are, if it's below that 40% rule, those projects would be eligible. That criteria does go up to 45% in 2026. And my point here being, any project that starts construction in 2026, there's one additional step that must be taken, preferably early on in the project, to make sure that it is compliant with FEOC. There's 2 ways to monetize these tax credits. One is the elective pay option. As I mentioned, local state governments, Alaskan Native corporations, tribal governments can all take the tax credit in the form of an elective or a direct pay. And there is a process to going through that elective pay option, which I'll go about in a bit. The other option is actually selling the tax credit in a marketplace. Our experience in the last few years has been that most of these tax credits were sold in the marketplace for anywhere between 88 to 92 cents on a dollar. Now that market has obviously matured, and we are in the current year 2025, we've seen about 84 to 89 cents on a dollar. So again, it all depends on the marketplace company, the buyers, the sellers, obviously. But that's a good option for companies to use, especially if they are looking for capital flow to come in. Now, both these options, whether it's the elective pay option or the transferability option, both of them do require a pre-filing registration to be done through an IRS portal. The timeline for that is, even though the IRS recommends that the registration number be received within 120 days before the tax filing deadline, but our preference is as soon as the project gets placed into service, start that pre-filing registration. And we've seen about 3 to 4 months for that registration number to come by. And once you get that, we can get started on actually quantifying the tax credit, and all of that goes into your final annual tax return filing. So this process is critical, and especially more so with non-for-profit or government entities, just because they cannot take a tax credit through elective pay once the tax year filing or the returns have been done. You cannot retroactively go back and take the credit on a prior year. So that's the only thing that I like to mention on the elective pay option. All right, polling question.
Okay. Starting from 2023, the following entity or entities are eligible for the elective pay option: A, public school; B, tax-exempt building of worship; C, nonprofit hospital; or D, all of the above. This is the last of our 4 polling questions. Again, you do need to respond to 3 of 4 and attend for 50 minutes in order to be eligible for CPE.
Yep. And on this note, with regards to the question, the answer is all of the above. But starting from 2023, because of the elective pay option, school districts, local governments, churches, religious organizations, if they were installing solar projects, and I'm using an easy example here, but if they were installing solar projects, they were eligible for that minimum of 30% tax credit, almost coming back as a refund check back from the federal government. So you may still have a bunch of projects in 2025 that could be eligible for elective pay, and certainly worth looking at. There is one question. Again, if there are more questions, please do send that on the Q&A tab. The question, I believe, is for 17090. Is there a target completion date? Generally, what the IRS looks for is, sure, there is the construction start deadline date, but there also needs to be some form of continuity with regards to the construction, in the sense being you can't just start construction then sit on it for a year, unless there were certain circumstances that led to that. But there needs to be continuity in the construction itself. And in general, it used to be 4 years or within 4 years of start of construction for the project to be completed. But again, there's caveats to that as well, and there may be certain delays that can be used, but it's usually a 4-year window before which the construction must be completed.
Are there any other questions? Looks like there aren't. Well, thank you for joining us today. Thank you, Imran and Jordan.
Thank you.
Thank you, everyone.